I think
Jump in.
this looks great. Yeah, just jump in whenever you're ready.
Okay, awesome. Well, good to nice to meet everyone. I'm Josh Richman. We're gonna just do before we even jump in, I want to just start off with yeah, a short story of a self-funded search deal that of a Southeast based roofer. The deal closed in May of last year. Um, the business, so is a roofing contractor, roughly $10 million in revenue. 70% of it was commercial. The other 30% was residential, mostly residential new builds specifically. Um, what's important to note here is that 2 years ago, the company converted all their employees from W-2s to 1099 subcontractors. So they were, subcontracting the work out. Additionally, that 30% of revenue that was derived from the residential new builds was all done through via a general contractor. And the general contractor has a very specific and special type of insurance program called a wrap up. And the wrap up, literally, the idea of it wraps all the individual subcontractors into their insurance program. What's that mean? Well, if the general contractors provide an insurance, you don't need to provide insurance. The seller didn't realize this. A lot of insurance brokers don't realize this. So the company was literally spending additional, premium, on for coverage they didn't need. Um, Secondly, when we're looking at the business, I said that the business converted from W-2 employees to 1099 2 years ago. Well, the loss runs told a completely different story. Um, the loss runs had, claims of roofers kind of even falling off the roof, literally. And why is that? Why, if they're, 1099 contractors, why are they showing up when you're the company that you're acquiring's loss runs? And the answer is that the company was doing a really piss poor job of risk management. They didn't have subcontractor agreements. They weren't collecting certificates of insurance. So they had a bunch of uninsured subcontractors running around. And when they got injured, well, they didn't have insurance of their own. So guess who would the insurance would hit? It would hit the companies, and the company was paying, kind of dearly for this. It kind of defeats the whole purpose of converting from a W-2 to 1099 contractors. um the purpose of the story is kind of, twofold. One is it shows kind of the importance of insurance, really the complexity of it. It's likely right now, if you're searching for a business, debating about to embark on a search, insurance probably isn't likely in your wheelhouse. And it's typically an opportunity where, when you come in as a new CEO, you can improve upon, almost immediately. um, for best practices. And it also is just going to give you insight into an area of insurance that you probably know little about. The deal ended up closing. We were able to kind of, actually reduce the insurance cost on it. And they implemented subcontractor agreements for their subs, which was actually a requirement for one of their equity investors that came along. But um, that's a real live deal that closed, self-funded deal that closed, this past year. Um, if there's anything, honestly, just to kind of get out of, this half an hour we have, is really probably this slide. um some of you are going to go out and you're going to acquire a low risk business that is, maybe let's just say a bookkeeping business. Very low risk. You have very low workers comp, even your professional liability. There's not really much there, to have anything major occur. And because of that, do something to say, Andy?
Yeah, I know. Just to quantify it, if you think about if a payroll processor provider bookkeeper messes up, what's the potential ramification? If it's tens of thousands of dollars, it's not going to kill the business necessarily, so it's a low premium. But this slide, and I think Josh, what you're going into is really about the asymmetrical risk of really bad things happening. And so that's kind of why insurance is important, I think, more than anything else here when you think about your diligence work streams. Insurance is this item where, hey, if the company spends a little bit of money on it, or let me rephrase that. If it's a low risk business, then it's not really going to matter. If it's, and when we say low risk, it's what's the chances that something could happen that would blow up the balance sheet and blow up the valuation of the business. If it's a higher risk business, and the risk, this is to some extent, this stuff's intuitive, right? If you got people on a roof, if you're dealing with fire, any sort of manufacturing processes or commercial services, residential services where you're in people's houses and doing stuff that plumbing, electric, mechanical, all those things. There's this possibility that, geez, what if something goes terribly wrong? And that's where insurance really matters, where it's not only a big number on the P&L, but the possibility of it blowing up your business. And if you're signing a PG for an SBA loan, and suddenly you find out that you don't have insurance, Josh's story about the roofers, um, that that's a that's the kind of thing where it's a life ending, not life ending. Let me rephrase that. You know, done with the ETA phase of your life, moving on to a W-2 job again, kind of situation. That's what we want to avoid.
Yeah. And really those low risk businesses, you're going to get lower premium. There're going to be more insurance carriers or markets interested, and you're going to have greater coverage. On the flip side of it, a high risk business, go back to the roofing, you can go back to plumbing, HVAC, you're going to be paying more per dollar of premium. You're going to get less coverage, less markets are going to be interested in writing the business. It's going to have, exclusions. Um, whether that's work, you can't work on new builds, you're going to have torch down exclusions, you might have jurisdiction exclusions. And insurance is going to be part of probably a lot of your contracts. So really it's just understanding and that there's different ways to kind of manage insurance costs, whether that's through, mitigation the risk, whether it's kind of transferring the risk via, kind of subcontractors, maybe it's avoiding risk altogether, or focusing on kind of creating a culture of safety. Really, really short. I've been working within the search fund and broader ETA for probably 12 years. Um, I was working really more with middle market firms, and if you look, the middle the middle market investors, specifically, associates and VPs and managing directors, were investing out of their personal checkbook into what was a class called pledge funds at the time, and they would tap us to kind of come and work on these transactions, and we would just do them as one-offs. Fast forward to today, it's where we spend the majority of our time. Um, and some of those earlier deals would get sold to our middle market clients. Those successful searchers went out, raised funds, and before you know it, here we are today.
I'll keep my bio even shorter. All I've ever done is insurance due diligence for private equity M&A for almost 20 years. And if you look me up on Twinkie, it's my catchphrase. I insured Twinkies. That's a fun story. I've got a lot of other crazy stories about the weird stuff I've insured, but I quit. I went to business school and I went right back into insurance, kind of like The Godfather 3, where it sucks you back in. I don't know. Anyway, so that's my background. And this is what we do and love to do it.
Cool. We're gonna cover this really quickly. Andy, do you want to just jump in just to just set the stage and understand kind of commercial insurance? But Andy, I'll let you fly through this in
Sure. Sounds good. So,
a minute.
most people, their knowledge of insurance is typically limited to personal insurance. So you maybe bought a homeowner's policy or renter's policy, personal auto policy and umbrella. There's we go through this because there's some similar terms, but they have different meanings in personal lines insurance versus commercial insurance. Um, but at the core of it, when we talk about commercial insurance and what are we looking at for diligence purposes, there's really I get annoyed by this. I think insurance brokers really do a good job of trying to make this stuff seem more complicated than it is, and they tell you it's a specialized custom solution. Blah, blah, blah. Really, when it comes down to it, there's 5 different types of insurance policies that just about every company buys. And it's based on what that type of policy does. And for the most part, the policies are pretty standard. And there's some nuances there, but I'll just fly through these quickly. General liability insurance, that's the basic liability policy that doesn't matter what kind of business it is. It's the policy that covers slips and falls. It's the policy that covers things you might sell. That's products liability. And it'll cover completed operations, which is um, literally the work you perform for others. And what the policy covers, this is the other important part. It's bodily injury or property damage liability. So if your business, um, if somebody gets hurt or if you destroy someone's property accidentally, that's what that policy covers. And the funny thing is, it's literally the same policy form. Doesn't matter if you're an accountant or a plumber. It's exact same insurance policy, just priced differently, different ratings, and maybe some, exclude the specific endorsements to the different type of business.
Yeah. And this thing where it says products liability and specifically completed operations, we see it pretty common. I just got on a call with a searcher today. They'll have the premises liability for their renters, and then the seller doesn't have completed operation coverage or
Mhm.
products liability. So they technically they have GL, but it's not really covering anything but a trip and fall coverage. And
There's Sorry, I just wanted to say, when insurance guys, and I'm guilty of this too, we all use abbreviations that also have other meanings for people. So if you hear GL, you might think general ledger. We mean general liability. So WC, working capital. No, we mean workers' compensation. But to to Josh's point, yeah, it looks like they have insurance, and that's why diligence is so important. Is that we actually read all the policies, and most folks are not trained to read the policies and zero in on what matters and what's there and what doesn't matter. Um,
property, I can fly through.
go for it.
Property, it's three components. It's just you have the building. A lot of times that's owned by the seller. So important to look at the lease agreement, as you're nearing close and who's responsible for building coverage. Contents, that's really the business, personal property, inventory, computers, desk, chairs. And then you have business income, which is if you had a loss for the build at the building or the premise, and the business income would come and pay the net income you would have earned as you look to kind of restore, operations and any other continuing operating expenses. Workers' comp, obviously, workers' comp is, required in all states. In Texas, technically, you can, opt out of it. You got auto liability, and also included in auto liability, hired and non-owned auto, which is if an employee uses their personal vehicle for business purposes, or if you rent a vehicle for business purposes, there would be coverage in place, excess any personal insurance, and then umbrella. Um, Important what to know about umbrella is that it only sits over and provides additional limits over your general liability, your employer's liability, which is the workers' comp, and auto liability. A lot of searchers come in and they're like, "Oh, I've got umbrella. It's going to cover cyber. It's going to cover D&O. It's going to cover this whole big bucket," and it really doesn't. It's really important because it has a terrible name, but it doesn't. Um, a lot of companies post close, we recommend that if you have a board of directors, you'll have management liability, which is directors and officers. You'll have that employment practices liability for discrimination, sexual harassment, wrongful termination. Potentially, you have fiduciary and crime. Um, and then I think that you should all companies should also have cyber coverage. Um, Believe it or not, we see tons of cyber claims, invoice manipulation, social engineering, funds transfer fraud.
Can I jump
Um,
in one quick
yep.
thing, Josh? Because on cyber insurance, this is an important thing to keep in mind. It's not only liability. So if you have customer data that is,
Yep.
personally identifiable information, so it's that's why I don't call it cyber liability insurance. It's a first party liability, but then it's also this uh, coverage for, uh, I guess I call third party claims, where it's, um, or let me phrase that. That's a first party liability. It's like a property coverage for lost income. So if a hacker things like phishing and well, social engineering, phishing, and then also bricking. So if you're physically, if the computers are bricked and you can't use them anymore and you have to replace all your hardware, a cyber policy will cover that too. So it's really very broad and it's kind of unique in that way. It's worth mentioning. Not just you have cyber, technology risk. It's, it's soup to nuts.
And then, lastly, depending on the type of business, you may have contractors pollution, you may have technology errors and admissions, you may have, a products recall, you may have some foreign exposure, and then there's specific coverages, that would be kind of honed in on your business.
Ah,
Um,
it's my,
I
my
think
favorite
Andy,
slide.
as I
Right?
was gonna say, I
This
think this is
one,
your favorite slide.
this is one where I get all jazzed up about insurance diligence. I'm glad this is on video. Um, and frankly, this is why I like my job. It's really the only work stream to me that is uh, really, really close to the actual business diligence that you would be doing as a person buying a company. And the reason I say that is because, there's this common misconception. Oh, you guys do insurance diligence. Here's a stack of policies. Go do your job. And my answer to that is, I'll work with what you give me, and what we are able to get. But for us to be effective and do our jobs well, we really need to understand the business. And so, like, I, I just reminded me that we totally blew our intro because Josh, I forgot. We decided last time we did this presentation, somebody came up to us afterward and said, "Hey guys, here's what you start with. Tell everyone that you don't charge any money. Just tell them out of the gate. It's totally free what you do." And so
Gotcha.
I want to throw that in here because when you think about, okay, what if, how do we get hired and how does that process look like for insurance due diligence? Um, we literally we do the diligence work basically as a means of business development. So Josh golfs, he'll take you golfing. I'm a lousy golfer. I don't know. I like guess lifting weights and drinking beer. Anyway, but it's a weird thing to do as a business development activity. So for insurance diligence purposes, when we get engaged, we do the diligence work and then we become the company's insurance broker going forward. And our basic premise is, hey, those guys, if we added value, if we thought you were helpful, if you found us to be helpful, then we become your, insurance broker going forward, totally cost neutral because we get paid by the commissions that are built into the policies anyway. And those commissions don't change if you work with us compared to any other broker. All that said, when we start in on diligence, we really like to look at the whole company. And if you're setting up a data room, we like to look at each of the other work streams information, like the contracts with clients and customers, contracts with suppliers. Um, we'll look at the PP&E. I want to see if there's deferred capex. Are these guys taking care of their equipment? Stuff it's not obvious to the naked eye, if you will, right? If they're in a building and the building, even if they lease the building, but the roof is 30 years old, it's harder to get insurance on the stuff that's in the building because the roof is old, right? So there's all kinds of interconnectedness basically between each of the other diligence work streams and the property and casualty insurance work stream. Um, given the time, I don't know that I want to go through every single one of these, but I'm happy to circle back on it unless there's specific questions about the tie-in. But if anybody throws out one term on there and asks me how it's connected to property and casualty insurance diligence, I can show you, illustrate the link.
Yeah, I think what I'll mention is the big ones here where we typically see stuff is property limits.
Mhm.
The balance sheet will typically show, let's just say $500,000 of inventory, but the insurance policies, are only covered for $150,000 or something. It hasn't, so in the event of a loss, you're actually not fully covered. Contractual compliance, a lot of you, depending on the type of business that you ultimately acquire, you'll have very specific insurance requirements that may require, a $10 million limit, may have, or specific may require cyber coverage or specific eh, requirements that when you acquire the business, especially if it's an asset purchase and there's a new entity, that you have to go ahead and provide. Um, and then lastly, like the premium audit, these policies are all subject to audit. Your general liability could be subject to audit based off of payroll, based off of um, revenue, number of doc visits, and making sure those numbers are true and accurate. So it does kind of all, tie in.
That,
Um, and so for us, where when we and I can shoot out after a sample redacted report here, but what we're looking for is there anything material which is going to give you, your investors, potentially a lender, um, uh, a cause of concern before finalizing your investment, um, within the insurance and employee benefit, programs. And then also I noticed that I write insurance 101 up here. Right now you're likely in a transaction role looking for a company. Once you find a company and you move into the role of CEO, insurance benefits will typically fall on you. There probably isn't, a risk manager in place. There probably isn't, a CFO that's up to your standards or your investor standards. So it typically going to fall on you. So it's also just an insurance 101, 102. This is completely different than your personal, personal insurance, homeowners, etc. So it's also just an education for you to go in, and then we'll kind of hit each of these, the coverage gaps, the impact and valuation, coming up here. Um, we'll Yeah, as I mentioned before, we advised on a trailer manufacturer. A simple review of the policies was there was absolutely no general liability coverage. If a wheel fell off or anything, there was just no coverage in place. The seller just did not want to pay for coverage. When it became an issue was when, well, one, the searcher, wanted coverage, but the lender required it to come up, and that was an additional $40,000 to have coverage. At least when you're doing diligence and you take a look at the policies, you can understand that. Um, Here is a deal that was it was a West Coast based, uh, fire suppression contractor. And when we looked at the policies, there was a material exclusion. There was I think I have it up here. There was an exclusion for all work that was performed at aircraft hangars. And when we looked at the application and we looked at the sim, 5% of their work was actually performed at aircraft hangars. So, what would happen if there was a claim that occurred at an aircraft hangar? That you're out of luck. There's no coverage in place. So it's something for you to kind of be aware of. Um,
that actually flows really well to the next slide too, around quality of earnings, right?
yep.
Is if you look at a business and they're not insuring parts of the business, like the aircraft hangar example, um, do you go back to the seller and say, hey, we need to make an adjustment to EBITDA because this insurance doesn't meet basic standards of insurance that you should be carrying in this business. So you can't, the seller can't in good faith say, yeah, this is a reasonable insurance program to continue. Um, good example here. We've got the barbershop example. Um, so there's really two other ways besides the way Josh just mentioned about the exclusion of the policy, but what we see commonly is the premium rating basis. So the way policy premiums are determined is that they are a function of the rate times the exposure. It's pretty straightforward calculation. If the company, when they apply for the insurance at the beginning of the policy year, they provide an estimate to the insurance company of what they expect their exposure to be during the policy year. And then following policy expiration, the insurance company asks for the actual books and records of the company. That's the premium audit component. So what'll happen frequently in high growth companies is that they'll underestimate the exposure basis, which allows them to pay a lower premium when the policy begins. And then it's almost like free financing because then 2 months after the policy expires, the insurance company does the audit and they send you a bill for the difference between the expected exposure versus what the exposure actually was. Some companies, if you know you're doing it, great. I would encourage, most situations encourage our clients to do it. You know, it's a smart way to finance your premiums for free. But if you as a buyer are looking at a company and they do this routinely, or they had a unexpected high growth year, you could be buying the company only to find out after the fact that your go forward insurance program is going to cost more when you actually present the real exposure information in insurance companies, or it could cost more because you're going to get a bill when the policy expires for the difference between the premium, the audit and the deposit and audit premium.
Yeah.
The other,
Really,
no,
really important. And your Q of E advice that doesn't look into those details.
yeah,
They'll look at like, hey, what is the company, what their estimated premium for the year, but they're not going to dive into the financials and what they actually did. Um, and in a lot of businesses, especially when you get into some of the blue collars or you're bidding on jobs and you don't know what contracts you're going to win for the year, sellers will tend to lowball the number and just make it up at audit and try to take the free premium financing throughout the year. But when there's a huge discrepancy, there will, especially if it's a stock purchase and you're assuming the transactions, you may get a bill. And so it's something to be aware of. The other thing that's really important here is just rating classification. Um, the policy, there's a difference in some states for a high wage plumber or a low wage plumber. That being, I think those plumbers that make over, say, $50 an hour has a lower rate of per dollar for $1,000 of insurance than somebody that makes, less than, $50 an hour. Why? Because it's been statistically proven that higher paid, plumbers are less likely to have a claim. So making sure that those are, correct. There's not uncommon in some industries. I think it can be thinking of, some staffing businesses, even in the medical field where, sellers will try to get creative with who's actually on the work floor, who's actually in the office. Are they having a split role? Because there's a completely different, rate for each line. And it can make a big difference. So we'll confirm that. I've been part of deals where, um, you know, we've had some of the lead investors wanted us to go to the NCCI and actually confirm classification for certain workers, um, because they've done a lot of deals. They probably have been burned in the past, and they wanted to confirm that this is the actual rate, the right classification for this group of workers so that it doesn't get changed.
occasionally that works. Actually, Josh and I don't know that you and I ever talked about this, but I worked on a deal a couple years ago. We went back 2 or 3 years and got the company money back because their low voltage electrical workers had been classified as high voltage electrical workers. And so we got the California Workers' Compensation Insurance Rating Bureau to opine on it and say, you know what, those are classified wrong. And we actually got the company back like, I think it was something like $187,000 over 3 years. So there can be a
So,
silver lining for these sorts of mistakes.
yeah, there's mistakes, and then I think I had a tweet the other day that I think that a lot of insurance fraud actually occurs more on the insurance buyer's side or the sellers, in your case, where they're trying to get a lower, premium through different rates, different rating classifications, and so forth. Um, Here's just like a quick, Andy, do you want to run
Yeah, sure. Yeah, and I think that the takeaway here too is the way we kind of present our findings is to say, hey, here's what the company is currently paying, right? You're going to see this current expense, and this is what it looks like flowing through the financials. And our task of doing diligence to present it to you in a way that's actionable is to say, here's what it should cost on a pro forma basis. If they actually, and the highlighted part here is really important, this isn't us saying, oh, we think you should buy a higher umbrella limit because it's prudent, or you should buy cyber insurance because it's prudent. What our pro forma adjustment is here is saying, well, if the company was actually paying for the insurance that they need to have, like by contract, and if they were buying adequate property insurance, right? So if the seller's telling you that you're going to buy $1 million of manufacturing equipment, but they only buy a $500,000 limit, there's an adjustment there, right? And then similarly, audit adjustment, that's the other big one where if you're looking at a seller's model that says, you know, $500,000 of seller discretionary earnings based on 3 million in revenue, but you look at the general liability policy and it's based on 2 million in revenue, all those things factor into what should be a really obvious sort of pro forma adjustment for EBITDA. The second page here, and Josh, unless you have anything to add, the second page is where I'd say that our discretionary recommendations come into play, which is okay, now that we've told you what the company should be paying for insurance if they were doing everything um, correctly on the up and up without any sort of interpretation of nice to have insurance, right? We're talking about a true insurance spend. The second thing we do is provide a budget and quotes for a go forward insurance program that takes into account things like, do you have outside capital? Do you have outside investors on your board? Do you have a board? Um, will you take the business in a different direction? Are there certain risks this seller didn't buy insurance for, but you're going to want to buy insurance? Um, those are usually a lot of that sounds like it's incremental, but there's also a sort of another thing that happens too is you'll see a lot of sellers own real estate and they insure the real estate. And then going forward, you don't have to insure the building because the old co owns it or the seller owns it. Or a lot of sellers obviously think everybody does this. You have your own business, you run your car insurance through it, maybe your kid's car insurance through it. And so sometimes we'll have to pull those things out too and say, okay, well, we pull that stuff out. We can agree that this is what the go forward insurance cost should look like.
So just looking at claimed analysis and, experience modification forecasting, what's really important, we'll ask for currently valued loss runs, at least 5 years worth. Current year's claims aren't factored into current year's premium. Unlike your personal, maybe let's say auto, or when you get into a fender bender, you typically see a rate adjustment pretty quickly. Commercial lines take a while for them to get fully developed, and they can remain open. I've worked on, Andy, I think you're working on a deal now that there's like a $4 million open workers' comp claim. You know,
And it's not a large company. It's a company with $3 million in revenue, $1 million in payroll, and it's $4 million work comp can't claim where a guy lost both of his arms.
so stuff, it's important to kind of take note is that, yeah, you're going to be buying the business. Yes, it's going to be a new entity, and we'll make all this case. You're going to have new, there's going to be a culture of safety. We'll say all this to the insurance company. You'll have new subcontractor agreements, but you're still going to have the sellers, unless you're doing like a carve out, you're still going to have to take the seller's previous, loss experience. So if there's a loss this current year, and it hasn't been fully factored into the premium, you be able to know that, especially if it's a large loss. Other thing that's really important, especially any of those that are looking more in uh the trades, is your experience modification factor. Um, and this relates to workers' comp. Everybody starts at one. One is your C student kind of average. If you get below one, let's just say, above one, 1.2, 1.5, 2.0, that means you're 10, 50%, 200% worse than your industry peers. Your industry peers being the same classification of worker in the same state. And if you're below one, zero point 0.9, zero point 0.8, so you're 10, 20% better than your industry peers, well, you're going to be getting the discount of 10, 20%, or you're going to be paying up to 200% more. Why is this important? Besides a cost perspective, some of your contracts may require you to have an X mod below, a 1.3, a 1.4 or so. And your customers will ask every year for a certified letter from us to actually prove that. And why? They don't want to obviously work with, subcontractors, or partners that are obviously prone to injury and going to cause, because it loops them in. It's also good indication for you, as a prospective buyer. What are these actually real claims? Are they severity driven? That's why you buy insurance. Or are they frequency driven? Pulled backs, or maybe it's the company doesn't have healthcare insurance, they're using workers comp, for that. But it's a good insight into what the company actually is and what kind of safety culture they have as well. Very important, for the trades. I can't stress the experience modification factor, enough. Um, and then also it's because workers comp is required, in all 50 states except for Texas, where you can opt out. If you're unable to get coverage in the private markets, you're going to have to go to the state fund or the insurer of last resort. So you're going to be subject to their claims, their rates, and it's a pain in the butt. And you really don't want to have to go down that path, or like a risk or an assigned pool. Um,
Say, Josh, before you move on, I just saw the Xbox chat pop up on the government contractor question from
yep.
Austin.
Oh,
Yeah, that's huge actually. That's short answer is yes, and they're in a couple instances they're even more stringent on as a government contractor. What does the XMOD have to be? And I literally just had this conversation on Friday with a colleague, and it was like her client government contractor 1.0 or below. So definitely be conscientious of it. Um, if it's and Josh kind of said this too, but one of the things we'll do in diligence is if having that good mod is a, how you say it, like a basically a gating item for the business to work. And if we see work comp claims, we'll do a forecast of what the model look like based on the loss experience. So those claims might not be baked in the mod. We can look at it and say, all right, next year it's going to go up or it's going to go down, to kind of help you get your arms around it. You got it.
yep. There we go. Um, Another thing that we kind of, take a look at is, the motor vehicle reports. Are the drivers insurable? Are you able to add them to your insurance policy? Seems silly, but especially specifically in the trades, when, will your insurance company allow them? Sometimes they will, sometimes they'll put them on probation, sometimes they'll put them, you have to go through a defensive drive-in metric. Do you want to insure them? Do you want them, also subcontractor agreements? I typically find that most businesses, um, that are that searchers acquire typically don't have strong enough subcontractor agreements, if any, and definitely an area where you want to improve upon. And also just telematics, especially if you have, a large fleet, can really help uh, you potentially reduce premium, but also provide, options for more insurance companies. Um, Also cybersecurity, hugely important, no matter whether you're buying a tech business or a manufacturing business. Everybody has a cyber exposure. um, and one of the things that's eh, taking place right now in insurtech is the ability to do a cyber vulnerability scan, and this is part of our diligence, complimentary, and they'll assess the networks to see how strong they are. um, and then they'll come back and they'll give us the full report, and they'll say, hey, this looks great, we want to write the business, or hey, update your Java, there's been some leaked email addresses, clean up this, and then we'll write it. Or they'll be like, this is a disaster, we don't want to touch it. Again, it's just more insight for you, as a prospective buyer to take a look at. um, so a lot of that whole first section was just insurance diligence that we deliver through kind of a complimentary, report. um, And the second thing that we do is, insurance tends to be at the bottom of page one, of all the moving parts. But we also kind of help with the execution, whether that's managing, helping with the change of control triggers, what policies can be assigned, um, separating, between the sellers stuff that, claims that occurred on the seller's watch, but then were reported on your watch when you're the buyer. We also review kind of the purchase and sale agreement, as well. Uh, Andy, do you want to? I think I skipped
Contract
around a little
compliance
bit.
and review.
Yeah.
Yeah, we've touched on this quite a bit, but it's an important part of diligence too, is understanding, does the insurance program meet the contractual requirements of the client relationships the company has. That's a big one. Um, the other part of it too is vendors. If you wind up with any type of business that sources inputs from overseas, or if you're in some sort of distribution, that a lot of people don't appreciate the way insurance works and how it flows through from the manufacturer to the distributor, or even the supply chain of raw materials. Um, I've literally, I mean, I'm sure we've all worked with like companies like this. You're sourcing some sort of input material from overseas. You're buying it free on board in China, but guess what? You don't have an ocean marine policy. So you effectively have no property insurance on whatever that raw material is or input is until it actually gets to your warehouse. That can be a big problem. So we'll dig into all the contracts to understand who's responsible for insuring what and how much should the insurance be, as well as liability. Do you have are there folks that the business has relationships with, the business has to is responsible for, or vice versa? Does the business have protection from the insurance and contractual protections that it might have from its trading partners too? And I just add to that, stuff kind of comes along as the process tends to evolve. We do some of that during diligence, but sometimes it's, hey, we're going to sign these contracts, we need a new lease. So that's part of the ongoing sort of consulting engagement too.
Yeah. I kind of touched on this on the last slide, but we typically come in, I joke we work in private equity time, search fund time. Um, a lot of times searchers will kind of let us know when they're under LOI, perform the diligence, coordinate with the lenders, their insurance requirements, and then place kind of go forward coverage. I'd say most people engage us after they kick off Q of V, then engage us so that around 30 to 45 days from close. And it's just really ultimately, how do we work post close? It's really, we're the outsourced kind of risk manager, whether that's reviewing contracts, whether it's a buy and build and doing kind of bolt on diligence, and so forth, and managing claims on your behalf. And I didn't call it out before, but there's we kind of, there's two documents. You can just kind of put it up here. One is just a kind of guide that walks through, kind of an acquisition entrepreneur's guide to insurance, diligence, whether you're doing a stock purchase, an asset purchase, FREORG, or a carve out, and the different steps and the different diligence items that we kind of, walk through. And then this is, you know, we know that you got a lot of work streams, but if there's like 7, 8 questions that you need to answer, before you acquire the company, even this, I call this like the bare bones minimum. Just read through these questions. Like, don't wait, the material exclusions, the audit basis, change of control triggers in the policy, understanding the seller's loss history, and so forth. So, this QR code should work, and if you just click on it, you can kind of download the items. And Charlie, I can send this all to you after if you want to send it out to the group as well.
Perfect. Thank you so much.
Yeah, if you click on, once you go to the QR code, if you just go to the link, the Substack link, you can download all the papers.
Can I say one other thing? I know we've gone way over time, but our presentation here is mostly focused on property and casualty insurance, because that's when I get back to that asymmetrical risk question, that's what could blow up your deal. We also do employee benefits diligence for companies where they've got a material, sort of number of full-time employees that have medical, dental, life, the whole suite of employee benefits. So we don't talk about it as much because it's more of a check the box exercise, check a couple of regulatory things, but that is part and parcel of what we do too.
Awesome. Well, thank you, everyone. Guys have any questions? Let us know. Otherwise, feel free to follow us on Twitter, or feel free to reach out. We're happy to have one-on-one conversation, and as well.
Perfect. Thanks, Josh. Yeah, there is one question in here from Austin about how long the typical process is for diligence. And then, yeah, when you close, if you could just tell people the best way to get in touch with you when they want to reach out during this process.
Yeah, so I'd say that most of the time we like to be engaged 30 to 45 days from close. We can work a lot quicker. We just got to, quicker, but that sets the stage where it allows us to do kind of full diligence, jump on a Zoom with you, walk through the report, and then especially if you're doing, say, an asset purchase, then we'll have a few weeks to kind of fully market the program, if needed. The big thing is, just getting the items, and most of the items we need are requests from your, either legal or your QOV provider already requested as well. Best way to get in touch with us, just email, feel free to text, call, or even on Twitter.
Awesome. Thank you so much, guys, for your time. That was terrific. And I'll be definitely sending out these resources. And thanks for allowing us to record so I can get this out to the larger group.
Yeah, absolutely.
All
Thank you.
right.
Thanks very much for having us.
Yeah,
Yeah, take care,
absolutely.
guys.
Thanks, guys. Bye.